Hi, I'm Richard Vague with Tychos, and a number of commentators have recently pointed out how well the U.S. economy has done as compared to other developed economies. Here's a chart from an article written by one of them illustrating this favorable performance. This is GDP per capita in dollars, with U.S. growth significantly higher than the other countries in this group. Part of this is due to favorable exchange rates during this period, so to make it a little more straightforward, the following chart shows the average growth in real GDP from 2010 to 2024 in local currency between the U.S. and the three largest European economies, Germany, France, and the U.K., though perhaps we shouldn't consider the U.K. part of Europe at this point. Why has the U.S. economy grown so much faster? You'll recall from your economics textbook that GDP is private sector spending, consumption and investment, plus government spending, plus net exports, which of course means increased government spending adds to GDP. So let's take a look at the relative contribution of private sector and government sector spending to GDP over this period. Note, we have adjusted the government's reported numbers to capture government transfers to the private sector, such as the post-GFC stimulus spending and the COVID rescue spending, since those were self-evidently massive government spending programs. In all four countries, public spending has added roughly 60 to 70 basis points of GDP growth since 2010. So no country has a real advantage or disadvantage over another in this regard. What does stand out is the difference in private sector spending contribution to GDP. The U.S. private sector has added 1.8% or 180 basis points to GDP since 2010, towering over the private sector contributions of the European countries shown here, and clearly explains why the U.S. GDP has grown at a faster rate. Kudos to the U.S. private sector for that. It's not a wholly unexpected difference. The U.S. is a bigger market than any single European country, and Europe has fallen far behind both the U.S. and China on the innovation front. It might not be reasonable to expect this big a difference between the U.S. and these European countries to persist, but I will say that the biggest loser in the global competition between the U.S. and China has been Europe. Decades ago, it was the businesses of the U.S. and Europe that dominated. Then Asia began to ascend, and in that mix, it was China that elbowed past Japan and South Korea to be the dominant Asian economy. And now, the dominant position in just about any business sector usually boils down to the businesses of the U.S. and China, as with Huawei topping Apple in smartphone sales and BYD far outstripping Tesla in EV sales, leaving Europe's businesses too often well behind any of these. It's been hard for Europe to sustain a major presence in any market, with the U.S. and China bringing so much creativity, energy, and financial muscle to the contest. But let's get back to government spending. In the case of the U.S., 32% of GDP comes from government spending, which includes the deficit spending we lament so often. So we need to acknowledge the textbook formula for GDP and the contribution of government spending. But, you protest, while that may be true, we have a massive deficit, and the federal debt is now $36 trillion, which will burden our grandchildren and untold generations beyond them. And in fact, since 2010, the government deficit to GDP in the U.S. has averaged 6.2%. And it has been similarly high in the UK and France. Note as an aside that the US has had the strongest GDP growth and the biggest deficit. But is this $36 trillion in government debt truly burdening future generations? To answer that, please allow me to give you a pop quiz. The question is, what is the current net worth of US households? All household assets minus their liabilities. Don't fret if you don't know, since I'll venture to guess that most economists and politicians don't know this off the top of their heads either, if at all. In fact, in my experience, most of those can't even make a close guess as to the correct answer. The answer is readily available in the records of the Federal Reserve, updated each quarter. And even ChatGPT gives an answer that is pretty close. Do you have your answer ready? Well, the answer is that U.S. household net worth is now $169.4 trillion. That's an amount almost 5 times higher than the federal debt. In other words, the current wealth of U.S. households towers over the federal government's debt. 65.6 trillion of that household net worth is stocks, equities, and 38 trillion is net real estate. Hopefully, that helps put that 36 trillion in federal debt in perspective. Perhaps those billboards that show the total federal debt growing in real time by the second should also show household net worth, which in dollar amount has actually been growing faster than the federal debt, as you see in this chart. It gets better. Even though the U.S. has had the highest deficits of these major countries, its household net worth is growing much faster. Here's the chart showing those levels and that growth since 2010. So again, a seeming contradiction. High debt growth would seem to militate against high GDP growth, right? But no, as is the case with the U.S., high debt growth, including private sector debt growth, correlates to high GDP growth and is in fact causal. Here's the key. When the government spends money, it doesn't disappear. Expense has to be equaled by income somewhere else. For every government expense, including interest payments, somebody somewhere gets that as income. It turns out that somebody is in large part U.S. households. In other words, government spending ultimately goes into the checking accounts of households. And when the government pays interest, as is always so widely lamented, keep in mind that most of that interest is paid directly or indirectly to households. To repeat, if the government has a deficit, then by definition, some other sector has to have a surplus. A dollar of expense has to be matched by a dollar of income in some other sector. That other sector is largely households, and yes, households have been registering a large surplus. So it turns out that not only will future generations not be burdened with this 36 trillion, they already have that money, and lots more beyond that in the form of cash and other assets on their balance sheet. Assets, by definition, have to equal liabilities plus equity. It follows that if the government's deficit were zero and the amount of debt outstanding were zero, then households would not have received that income for all those years, and their net worth would actually be $36 trillion lower, or only $133 trillion. But you might wonder, will there be enough money for markets to purchase all the projected new government debt? We hear this question repeatedly. The truth is that the purchase of new government debt does not deplete the money available to buy additional government debt. That's the thing that's called the money supply. That's because government only issues debt in order to spend those borrowed funds. So if the government issues, or stated differently, sells $1 million in new debt, that removes $1 million from the nation's money. But the government always immediately spends those funds, paying that amount to employees, vendors, other citizens, etc., so that $1 million is immediately returned to the nation's pool of money. I mean, literally, most often, this is a matter of days. So the nation's pool of money, also known as the money supply, is always exactly the same after the government issues debt and spends the proceeds as it was before the debt was issued. How about inflation? Don't massive increases in government debt bring inflation, and along with inflation, high interest rates? Well, they didn't in the massive run-up in government debt in the 1980s. In fact, they did the opposite. Inflation and interest rates came down. And they didn't in the massive run-up in government stimulus spending after the global financial crisis. And in fact, they did the opposite. Inflation and interest rates came down. And they didn't in the massive government debt stimulus in the 2000s in Japan after its 1998 crisis. In fact, they did the opposite, and inflation and interest rates came down. So why is it that we expect something different here? These counterfactuals are plentiful. Our recent 2021/2022 inflation was instead the result of the COVID supply chain disruption, plus the disruption of the Ukraine war. And that inflation rate increase ended in July of 2022, almost 3 years ago. Well then, aren't we beholden to China for holding so much of our debt? And won't we be in trouble if they start to sell? Turns out China only holds $765 billion out of our $29 trillion of federal debt held by the public. The UK and Japan hold a bit more, $779 billion and $1.1 trillion respectively. Most of our government debt is held by American households directly or indirectly in pensions in the Social Security Trust Fund and elsewhere. And it's only a minority of that debt that is held by foreign central banks or governments. Frankly, China only owns U.S. treasuries because of our trade deficit with them. We pay them more dollars for the goods we buy from them than they buy from us, so they are left holding a lot of dollars and have to do something with them. And the easiest thing to do is to buy U.S. treasuries. Now, there is a downside to high and growing federal debt, and that is increasing inequality. But that's another subject for another day. By the way, we're not trying to sell you on this concept, nor are we endorsing the current presidential administration's proposed budget. If we had our druthers, we would certainly spend very differently. What we are doing is simply putting widely available data in front of you, data that is easily available to review, since in our view, the misperceptions on this are so pervasive. We think the data is pretty incontrovertible, so we're happy for you to examine it and draw your own conclusions. But we have found that even the most highly regarded commentators on this subject can't answer today's pop quiz or the other basic questions implied by the data shown here. That's it for this week. Thanks.